Well, hello, ladies and gentlemen. Welcome to the Stock Market Brief Show, the show where we navigate the financial markets through the lens of technical and intermarket analysis. On today's episode, we're going to be talking about the bond market, some things that I'm seeing. I'm going to talk about an opportunity in Tesla stock, or a potential opportunity, and why I think it's one. I'm going to give you some thoughts on the current market rally as well. I'll update you on the expected moves, so much more on today's Stock Market Brief Show. Once again, if you haven't seen the links in the pinned comment or the description, these shows are brought to you by my Patrons. They are the ones that support the show, as well as my partners, Interactive Brokers. Let's get into today's episode. All right, people, welcome back to the show. Hey, before I actually start talking about everything, just a little update. I think I'm going to be doing live streams here starting in January, potentially earlier. I've been talking with Twitch, and they have this accelerator program, so I might be streaming on that platform for about 3 months or so to trial it. And if I really do like it, maybe I'll come into YouTube as well. But if you have ideas of what you might want to see me live stream or when to live stream, it might not just be the Stock Market Brief Show. It probably will be during market hours. So if you have any ideas or what you might want to see on a live stream, let me know in the comment section below to give me some ideas so I can consider it when the live stream takes place. So today in the news, we had the bond auction. The time sale of the 20-year bonds draws good demand, and that had a very big impact, obviously, on the yields and bonds. The 10-year yield, when that came out, saw a big old plummet, kind of forming a bear flag right there. Meanwhile, the TLT, we shot up higher, and we kind of flagged here too as well. If you take a look at the 10-year yield on the daily time frame, not just those shorter term time frames, we still have that head and shoulders pattern that we've been talking about, that 4% to 4.1% for being a measured technical move into that area. And that does line up with prior areas of resistance and support, so that could still be very well in play. We talked about the negative divergence forming here, and even on the monthly time frame. So we're seeing the market pull back. Now, there's another way to look at this, and I'll walk you kind of through my thought process, but one of the things that I posted on Twitter, which I'll show momentarily, was the 10-year yield is potentially wedging. And this is, a bullish wedge where we can potentially break out and start heading right back up to 5%. But really what to call out here is, yes, you have a head and shoulders type pattern that's breaking down, and that's still active. But if price comes back above this area, it kind of invalidates that, and it's more of a bear trap, and then it starts pulling back up. But what I'm seeing here is just price action, right? It moves between expansion and contraction, and as it stands right now, price is coiling up very tightly within this area. So that means that we might see a very quick and sudden move to the downside, or potentially be on the lookout for a potential break to the upside. Either way you look at it, price is contracting and coiling up, offering up a better risk versus reward. This is one of the charts that I showed on Twitter where I showed the 10-year yield wedging as it currently is still. And, the energy sector has a very tight correlation with oil, and obviously the 10-year yield has obviously a tight correlation with oil as well. So you can see oil breaking down, and we're seeing that reflexive bounce. Even today, it was up 2.35%. But you can see as that's been coming off, energy stocks have been kind of coming down too. As the 10-year yield rises, look at energy prices, energy sector rise as well. The energy BPI RSI, which is the bullish percent index, we called out 2 days ago, or 2 trading days ago, right here on, I believe, this day. And we talked about this being a potential opportunity because this was one of the only oversold condition bullish divergences that we saw on the various sectors of the bullish percent index. And since that point, we've saw 2 pretty nice days to the upside as price action still in this kind of contraction pattern, and the RSI still actually remains in that oversold state. The last time we had that bullish divergence was over here, and you could see that the price action went lower, the RSI went higher, and the energy sector did end up kind of clicking up higher. So that could be one to obviously watch. We'll continue to keep an eye on oil as it's just seen a little reflexive bounce here from being, over 24 to 25% of a sell-off. I'm not going to get too much more into detail of that because we talked about that more on the other episode. I want to get back into the yield curve. More specifically, I want to look at that yield curve and how it's been kind of coming off into a more deeply inverted state. And I shared this chart just recently on Twitter. Really, what I want to call out here is you can see as the yield curve, which is the top chart, the S&P 500 is the lower chart. But when we went through this 10 10% correction in the S&P 500, what was the yield curve doing? It was moving from a state of over 100 basis points of inversion to trying to get out of that inverted state to move up into that zero line right there. When it uninverts, it goes back above that marker. And then this current rally that we're seeing, what's it taking place on? Well, it's taking while a yield curve is currently still moving into a deeper inverted state. And this has been going on for quite some time. When we went inverted, we saw a deeper inversion, the market rallied, right? We went deeper into inversion, the market rallied, deeper into inversion, the market rallied, deeper into inversion, and the market rallied. Now, the reason why I'm calling this out is because there will come a time where we uninvert. Could be when potentially the Fed lowers rates. Now, currently the Fed funds futures it's currently saying that we're going to be keeping rates paused till about March, and then in the May meeting, the probabilities are increasing that they're going to start cutting rates. And this is interesting to me because the Fed has said that they're going to be holding them higher for longer. So as the market's rallying, if the Fed is going to hold rates higher for longer and surprise the market's currently pricing in the cuts. So what happens if they do keep rates higher? Is that bad for the market? And what would the Fed have to do to break course from what they're currently saying? They're currently saying they're going to hold them for higher for longer. So if something were to obviously break, that could bring them to change course and start lowering rates at a faster clip, which has not really been good throughout history. You can actually look here at the Fed rate hike cycles, right? We moved up, we went into a deeper inverted state. When we're moving up, we went to a deeper inverted state. We moved up, we went into a deeper inverted state. And really, things started breaking down like the dot-com bust, the great financial crisis, even going into 2020, where we went inverted and we uninverted at that point, and we went on that rate hike cycle. Really what took place was when rates started dropping and we started moving from an inverted state to an uninverted state, that's when we start to see much more volatility in the markets. And we've been talking about that. And I want to continue to just bring this home because the market is rallying right now. So price action's moving forward, but you just got to be understanding of the current environment that we are in. All right, let's hop over to the monthly chart over here on the S&P 500. We are up 8.43% on the month. So we are seeing one heck of a comeback after 3 months of downside. That'll change sentiment and that'll change it quick. Now, I wanted to call out this level right here. That's 4,600, slightly above. And that is the quarterly expected move. So we're well above the month-to-date upper weekly expected move as it stands. Remember, 68% of the time it finishes within there. So it's still a possibility that we pull back in there. We've seen one very strong move, and obviously we still have a lot of time left in this quarter, and we're already reaching up to that quarter to date. And this level, it's important to watch that 4,600, and I'll talk about why that is in a little bit later in the episode when I go over some gamma levels. If you take a look at the Qs are up 11.36% on the month. Now, this is an insane month. This is very rare to close the Qs or the NASDAQ 100 to be up 11 to 12% on a month, and I'll prove it here. But I first want to call out that, we're up already 11.36% on the month, okay? And we're up there at that quarterly expected move. We kind of peeked our head outside of it. Now, why is it rare? Well, let's look at a monthly chart of the NDX, the NASDAQ 100, and we're dating back all the way to 94. Now, if I just go 20 years to 2003, the start of 2003, what I'm calling out here is the current NDX is up 11.22%. So you see that right here. Boom, it's right here. I put a horizontal line, you go across, and then you look at the times that how many other times have we actually had a month that finished up this high? And you can see here we did once, maybe twice here, 3 times, 4 times, 5 times, 6 times, 6, we can call that maybe 7. It's not quite touching in 20 years, right? So 6 different times, 6 occurrences in a month, 6 months, did we finish up that high on the NASDAQ 100. Now, you can look back here and you start to see a lot more times. And the reason for that in 2001 is we saw this parabolic move, but you typically had it follow, much more volatility. So when you saw months that were obviously, you can see the volatility actually expanding here, right? So you see the rate of change go up, and then all of a sudden you see a big, huge down month. You see a big, huge up month, followed by another big, huge few, down months, and then it regulates itself. And it's like, okay, volatility's coming down, right? The Fed steps in, right? And we start just drifting up higher. We went through the 2008 financial crisis, and you saw like a big down month, right? Almost 17% down in a single month. What's that followed up by shortly thereafter? Well, boom, boom, we saw a month that was up, over 12%. So that's typically what happens. So the reason I'm calling out is because very rarely, very low month followed by a very high month, a low month, right, followed by a big up month. We're having a pretty big up month. We had, 3 months of down, and we're kind of, this last prior month, it was, minus 5%, right, right down right here. So we're seeing kind of a reflexive, pretty darn strong, recurring move as we're reaching up into that quarterly expected move. So the reason why I'm saying that is because we haven't had much consolidation on the lower time frames, and a lot of these other, big tech names, they've been going, pretty much straight up. So you just got to be very careful up in these areas to see how price consolidates the move, and just, don't get caught in too much FOMO, because these are rare occurrences. And typically when you start seeing outsized moves, they're followed same with some outsized moves to the downside and or outsized moves to the upside from, if what preceded it was a big move to the downside. Let's take a look at the dollar. What's really projecting this move up forward? I mean, it could be the dollar. The dollar came off hard. As you can see, boom, and then right here, what's the S&P 500 doing? It's ripping up. So what happens if the dollar starts catching its legs and moving back up? Well, that could spell out, obviously, some, drama back for the S&P 500. So the dollar's coming off, which has been pretty bullish overall for equity markets. If you take a look at copper, the move down in the dollar really actually propelled this copper move here too as well. This was a pretty large outsized move. You can see we have a low, a higher low, and we started contracting here, and boom, we blasted through. And that really has a pretty strong correlation overall with the S&P 500. So we'll see here if we get, if this is the start of a stronger move overall in copper over time. But I will call out that we have this high over here. You have this high in the S&P 500. This is still much lower. Okay, this is almost lower, but if we're going to come up to that 4,600 area to test that, well, we'll see if copper can reach up all the way to the $4. If not, that would still be kind of diverging from the price action, which we've talked about those divergences in the past. Dollar was down big, but gold was down alongside of it. It did come off far from its lows, but overall we saw a nice bounce, and now it's kind of consolidating there. I wanted to bring back the Sailor to Shift tool. You can see the rate of change between Bitcoin and gold. It is pointing down, still above the zero line. So I would say once we have a weekly close below the zero line is when I'll bring this back, and then we look to see if price gets below the prior week. And if that's the case, it triggers a sell signal on this specific strategy, and it's led to some pretty large downsized moves. So we'll continue to watch that, see if this thing, but overall, it is still technically on its buy signal. The rate of change is just coming off a little bit. If we take a look at the S&P 500, 11 sectors that make up the S&P 500 over here on the right-hand side. Technology, communication services, and real estate kind of led the way. So tech being up there, more of a risk on day, whereas the bottom, you have consumer staples and utilities, more of a risk off type of day. You can see that here, the VIX is coming off, and you start to see the NASDAQ 100 was the leader, heavy tech. You have the NASDAQ composite, boom, up too big, and then everything else was green there on the day. You can see the S&P 500 on the 15-minute time frame came into the upper daily expected move and then started acting as resistance. What pushed this through? That was the bond auction when the 10-year yield really came off, really set the move forward on the overall S&P 500. And if you are watching market flow, if you're in actually the Discord and you look at the market net flow, you can see that I don't have the chart in front of me as it stands, but market net flow was bullish for the entire day. It wasn't something that you really want to fade unless you get very tactical at some key levels. The upper weekly expected move and the lower weekly expected move we'll go over here momentarily on the updated chart with the new daily expected moves. Going into tomorrow and the rest of the week, all traders are currently eyeballing, obviously, Nvidia. This is going to be the big one. Nvidia is a larger market cap name. It's reporting earnings. As it stands right now, there's a $38 expected move, a 91.46% implied vol, which would bring us technically, about 7.5 to 8% up higher to around 540, and to the low would be just above 460 over here. So I fully expect us to tag or exceed one of these levels as we've been watching these earnings. The last earnings for Nvidia, it was like a 3 standard deviation move. This thing ripped, and we just saw monster volatility swings back and forth, and we're seeing a monster volatility move, obviously right here heading into the earnings. So just be aware that this is where things could get dicey. Obviously with implied volatility kind of just swelling up. So that's going to be one to watch. As far as macroeconomic calendar going into tomorrow, we do have, FOMC minutes that might bring a little bit of volatility. We have a couple other, Chicago National Fed Activity Index, red book year over year. Some of these may bring it. We have a couple auctions. Those have been adding volatility, but overall, nothing that stands out like too much. Just be aware of the times. This right here is Pacific Standard Time, so you can pull up Eastern Standard Times if you go to the Trading Economics calendar on their website. Let's take a look at the SPY on the daily time frame. So very interesting trend line, right? The all-time high over here, I believe that's the all-time high. Yeah, all-time high in the SPY connecting to the previous, actually the current 2023 high. It's lined up perfectly. We found a little bit of resistance right there today. So we saw this move down. Where do we see the move down to? Came right into that crazy consolidation that we had right here that we're tracking, which also lined up with prior resistance, prior support, right? We broke down. So this line right here at around 410 has clearly acted as a level of resistance, and it clearly acted as a level of support. So overall, a very important area. We blasted up. This was an insane move, right? Now we're coming in to trial out this trend to potentially try to take out the prior 2023 high like the Qs just previously did, and then try to take that 460 level, which we'll get into right now. Okay, so if we take a look at the S&P 500, this is the XPX. You see that 144M. If you want, that's a gamma exposure, what's currently there, and that's the larger call wall. And those call walls, they can act as potential areas of resistance, right? So that is the key level to kind of hone in on as the week progresses. Now, as the week progresses, we're already up at it around the upper weekly expected move. That's 45.62 and 88 cents. If you want these levels, just download the chart deck. I make it available, so you can just download it. Okay, now I want to go and look at this level down here at, what's my mouse doing? 44, what is going on here? 44.70, that's the gamma flip level. So this is up a little bit from the prior week too. Remember, since we're in positive gamma territory and, CTAs have been just hitting these buy triggers, so this thing has been just on a monster rally. But typically, from a gamma flip perspective, when you're in positive gamma, dealers, they look to sell into strength, right? So they typically sell, but this has been kind of a one-way street, and then they buy dips. So we're currently in an environment where you look to buy dips. So if price pulls down, right, you can look at the lower daily expected move or the 5-day moving average. As far as local support goes, from a gamma exposure level, 4,500 would be the local one right now. We'll see what happens when it opens up in the morning. See some zero date levels, because a lot of this is going to be controlled by zero date flow on a holiday weekend, right? Holiday weekends, you typically have less volume, so flow can make a big impact. And then we're still overall in an uptrend, right? So, just be careful fighting the trend. 5-day daily moving average is moving up. What you want to see is that to start flattening out. When it starts flattening out, then, the trend goes to neutral. When it starts declining, that's typically when price breaks down and we move into more of a stage 4 decline, at least in the shorter term trend when looking at this. If I take a look at back month versus front month volatility, still some upside up here to that 20% level or that 1.2 level. When we get up into these levels, we've seen the market kind of pull back. It's happened multiple times in the year of 2022. And then over here in 2023, we saw it a bunch of times where it kind of just chopped up before we saw that explosive move, but we still did see it kind of pulling through over at those levels here too as well. We still have a negative divergence that's building on the Nyse-McClellan oscillator. You can see lower highs, higher highs right here as price action's kind of coiling up. So we'll continue to monitor that one and see if it plays out. This is getting to overextended state. When it's up in the 250 range, that's much more of an overextended range. It doesn't hold up there for too long and you typically get pullback. So even if this were to come up here and price action follows suit, that would technically still be a negative divergence that's currently building. If we look at the old full indicator, a few trading days ago, we did cross over to have a bullish signal and we're getting some follow through today on that. So this is identifying a potential change in trend. That's obviously after a very strong move. So just be aware that we might need to still consolidate, but this could identify a stronger change as this identified a stronger change to the downside. Now we're starting to flip back up. So we'll continue to monitor that, see if it changes. I went over a lot of bullish percent index charts on the prior video, so I'm only going to look at the NASDAQ. I just wanted to call out that it's still in an overbought state. Overbought can stay overbought for a while. And when I look at something like the percent right here, 43.6, it's actually, it's an RSI is an overbought because of the strong move, but this is still relatively low overall. So this could be one that forms a negative divergence, meaning if this wants to continue moving up higher, right, maybe perhaps the RSI comes down, you have a lower high there, and this puts in a higher high. So that would be the negative divergence that I would be looking for on these various charts. Now, let's talk about Tesla. Tesla would be a potential trade idea. This is something that I shared with my Discord group. And I'll call out why. This right here, so today's price action, Let me first call out Tesla is a large market cap name, right? So you have Apple, you have Microsoft, the two of the largest ones, right? You have Nvidia, you have Meta, right? So these are some of the bigger names. And if you look at all those charts that I just called out, they're basically like this, boom, right? Just straight up closing at the highs so far. They've been just a monster move. Where Tesla is actually currently consolidating. So this one's a little different. So my thought process is, hey, if the bullish momentum is going to continue, where are people going to look to potentially see, the opportunity? And that could be Tesla, because Tesla is not running like all the other big mega cap names. So currently, as it stands, price action is in this down channel, okay? And we had recently, just today, a inside trading day. Now, inside trading days could be traded a couple ways. So you have your one candle, your body, right? That's the body. And then you have this other candle, boom, and you have this body. So this right here is just representing price action's contracting, and it's contracting in a flag pattern, right? So price action, it moved up, and now we're consolidating. This is not necessarily bearish right there, but how you look at this from an inside trading day is if it starts breaking up to the upside, this is one way you can play it. You can have a stop loss just under that candle. Now, if it breaks down from this before breaking out, then obviously watch out. There's been plenty of times where it goes like this and this, and it starts whipping everywhere. That's more than possible on volatile names. Okay, but that's typically how you play an inside trading day from a tighter perspective. Or you can look at this, you can potentially play a breakout flag up to the upper trend line, right? And then have a stop loss, right around this gap fill. Or if you're really bullish on the price action, you think it's going to continue to break out of this flag pattern, well, you can have a stop loss down here or even down to the swing low. But remember, your position sizing will have to change, from, tight and aggressive to a little bit looser here, as far as, less of a position size, because you'll be taking a bigger swing overall. The last time we talked about this on the show was actually this consolidation right here, how it looked very similar to right here. We get this gap down and went up, kind of cupped, boom. Well, we went down, we cupped, right? And then we broke out to the upside. So right now, we pulled back a little bit into that. We found some support. Now we're starting to consolidate. And this could very well open the door if people start looking at this as the next potential opportunity, because everything else made a big run. If not, like I said, it's, tight risk management skills would invalidate this trade idea. And then you would just re-wait for it to set up. That's all I got for you on today's episode, everybody. Hope it helps out. I'll see you on the next. See ya.